Good afternoon and welcome to this month's Employee Benefits Compliance webinar. I'm Jenny Bedell with Assurex Global, and thank you for joining me here today. Today, the Benefit Comply team will be covering ACA Employer Reporting, a very timely topic as it is ACA reporting season yet again. However, before we get into today's presentation, we'd like to start with a couple of polling questions. Give me just a moment and I will get those launched for you. You'll see our poll topic today is long-term care insurance. We are curious if your company offers long-term care insurance, and if so, we have a follow-up question regarding the type of policy offered. Please take a moment and submit, whoops, and I apologize, I have launched the incorrect poll. My apologies. Let me pop back. I got ahead of myself. You all just got a sneak preview of the poll I'm going to ask you during my closing comments. There, that looks a little better. So we are curious if your company offers long-term care insurance, and if so, we're curious around the type of policy offered. So as you are submitting those selections, I'd like to extend a thank you to your local insurance benefits advisors and consultants who are partners of Assurex Global for making today's webinar possible. And we do welcome your questions today. If you have any questions throughout the presentation, please submit those over to us using the Q&A function at the bottom of your screen. We'll get to as many of those as we can today. And we do record these sessions. A link to the recording, as well as a copy of the presentation slides, will be available early next week from the benefits advisor who invited you here today. And I will also drop a link to those presentation slides in the chat here in just a moment. All right, I'm going to give that poll just another moment here to allow a few more responses to come in. And I did want to mention we are focusing on long-term care for our polling questions today, because while the need for long-term care insurance has always been there, the legislative activity that's happening at the state level has really brought it back into the spotlight. So we really just wanted to get a pulse on where employers are at. All right, the sneak preview is most of you are not currently and are not planning to offer insurance. Long-term care insurance. Let me close out this poll, give you a peek at those results. And thank you as always. And as you saw, I do have a second follow-up polling question for you during my closing comments. Let's get into today's content. Joining us from Benefit Comply, we have Amanda Olam, consultant, and Regan Debin, principal. Team, I will turn it over to you.
Thank you. All right. And Regan, did you want to kick us off with a few opening
Sure, I can do that. Just wanting to let you know that we now have the final instructions and forms for 2024 from the IRS. And so it's the perfect time to do a refresher. You can see right from the agenda kind of what we're going to take you through today, talk about who, when, and how for all of the ACA employer reporting. And then we're going to actually jump to the coverage reporting or enrollment reporting for self-funded group health plans. Whether you're large or small, if you offer self-funded or level-funded coverage, you'd have to do the coverage reporting. And then the second half of the webinar will really focus in on the requirements specific to applicable large employers, those of you with 50 or more full-time equivalents. So if you are here today just to kind of get a quick refresher on the ACA employer reporting and you're a smaller employer offering just a level-funded plan, for example, and maybe stick around long enough just to make sure you understand the definition of applicable large employer, but then that may be the bulk of what applies to you today. And then the rest of it would be specific to applicable large employers. As we go through the reporting today, I do want to let you know that we've compared the instructions from this year to last year, as well as the forms for both years, and there are no significant changes. And so we expect that the reporting process is going to look and feel very much like it did last year, which is good news for those of you that have your process in place. But now is the perfect time, because you maybe have set this aside and not thought about it for a year, to make sure that you understand what you need to do, which forms need to be filled out. We've got the updated deadline 5 and go through and give you some of the tips and tricks that we've learned. Amanda and I have worked with hundreds of employers using lots of different vendor systems to get this report with lots of different IRS penalty letters and appeals. So have learned a lot over the last several years of employer reporting. So as we go through today, we'll try and give you some of those tidbits that we've learned along the way. But with that, Amanda, I'll go ahead and turn it over to you to take us through today.
Perfect. And Reagan will be watching the questions inbox for you guys, so feel free to submit them for you. So like Reagan said, we're going to start out with just kind of the basics. Who has to report? When is the deadline to do so? And then the forms we'll kind of go over. How do you go about getting that reporting completed? So we have a graphic here for you. The top two parts of the graphic in gray, we have, it's just to show you for the employers that are offering self-funded or level funded for this purpose. Level funded is the same as self-funded. Even if it's a MEC plan, right? If it's a typically preventive only type plan, if it is self-funded or level funded, there's going to be reporting that you are going to be required to do as the plan sponsor. For that reporting, you are going to be reporting specifically the coverage or enrollment information, which means you need to report on every individual that is enrolled in your self-funded plan. And then separately, there's also reporting that is applicable specifically to applicable large employers, which is 50 or more full-time or full-time equivalents. For these purposes, you're going to be required to report the offer of coverage information for all full-time employees. This is going to include things like whether the employees enrolled in the coverage or waived, what the employee's employment status is, so full-time, part-time, maybe not employed for 1 or more months, whether you made an offer, and then whether that offer was for coverage that met minimum value and affordability requirements. So that is kind of the overlay of it, and that reporting is completed on forms 1094 and 1095. So now we will get into the deadlines here. So for the 2025 reporting that we're going to be completing, the reporting is actually for the 2024 calendar year. So January through December, that's the case regardless of when your plan year actually is. So the reporting for 2024, if you're going to do a mailed submission, it's February 28th, the deadline for mailing that into the IRS. The deadline to get copies of Form 1095 to individuals is March 3rd. And then finally, the electronic IRS submission is has a deadline of March 31st. We do have extensions available, not specifically for the deadline to get copies to individuals. That is a hard March 3rd deadline with no possible extension. But there is a possible extension for that March 31st deadline, which is an automatic grant of 30 days as long as you get Form 8809 filed prior to that deadline. That said, last year we had a change where electronic submission to the IRS became required for any employer that is filing 10 or more forms with the IRS. So in other words, if you're filing 10 or more forms total with the IRS, you are going to be required to do that submission online. One thing we'd want to clarify here for you, when we say 10 forms, we're not just talking about the 1095s here, right? Basically, all employers who are going to be required to do this reporting are going to have to do it electronically because it's not just 1095s, it's W-2s, 1099s, tax filings. So that February 28th deadline is kind of no longer relevant in this era because, yeah, I haven't seen an employer yet who would be required to actually do this reporting that would be able to use a paper submission anymore. So I said earlier in this, in the last slide that we talked about, we're doing the reporting on the 1094 and 1095 forms. There are essentially 3 different series of those forms. There's the A series, which is just for the exchange, so we're not going to worry about that. The B series, which is essentially used for self-insured plans. And then the C series you have to use if you are an applicable large employer. In addition, you can use the C forms when you're an applicable large employer if you're also self-insured. But as you can see from this graphic here, you would also have to fill out Part 3 of 1095C to complete that coverage reporting that is applicable for self-insured plans. So this is just a good slide to keep. You can see a copy of the presentation now in the chat. If you're ever confused about which forms you should be using to complete your reporting requirements, this is a good way to look back and remind yourself. So you'll notice really the only employers that are completely exempt from reporting obligations is going to be a small employer with a fully insured plan. Reason being for that, the carrier is going to complete that B reporting on the coverage information. And if you're a small employer, you don't need to do the reporting for applicable large employers because there's no potential for you to be penalized. But yeah, this is just a good graphic to go back to if you are ever, like I said, confused about which forms you should be using. Okay. So we are going to focus in now on self-funded group health plans and the reporting that applies specifically to those plans. So all self-funded, like we talked about, and level funded for these purposes, same things. Plans that provide MEC have to report on all covered individuals. So this is going to include employees that are covered, but also non-employees. So your COBRA participants, your retirees, and then also your spouses and dependents. If they are covered by the plan, they need to have this reporting completed for them. So you would complete this reporting by completing a Form 1095 for each primary subscriber of the plan. And then on that same form, you would list the spouse and dependents that is covered through the primary subscribers on that same form. You may have a situation, for example, under COBRA with a divorced spouse, where that spouse then becomes the primary, the ex-spouse becomes the primary subscriber, in which case you may have to be filling out more than one form for what you previously had one form for, right? So it's really about the primary subscriber, and that's how you determine how many 1095s for these purposes. We wanted to talk a little bit here about the solutions that are available to assist you for this. So for level funded plans, we suggest that you check with your carrier because it's possible and probably more likely for a level funded plan that the carrier is going to be able to assist you with this. At the very least, they'll probably be able to provide you with enrollment data. Beyond that, though, there are solutions available, and they kind of range from assisting you to actually complete the reporting, fill out the coding, get it submitted electronically, potentially even sending the forms out to individuals as more of kind of a full service type model. And then on the other end, there's more of kind of a self-service model where you may be responsible for doing more of the actual filling out of the forms, but with the assistance of a TPA to at least help you get it filed with the IRS, because there is a specific way to do that electronically, and we have seen that be pretty confusing for employers in the past. The other thing to note here, the last bullet on the slide, if you are also an applicable large employer, when you are going to purchase a solution, if you're self-funded, also you should ensure that that solution knows that you're self-funded. Another place that we've seen this be an issue is if you are an applicable large employer, you have been in the past, you have your solution already set up, and you were fully insured and you're switching to self-funded. It's important when that occurs to make sure the solution that you're using to complete the reporting knows that that switch has occurred. Otherwise, you're not going to get that Part 3 of the 1095C filled out, and that's where you actually complete that coverage reporting that we were talking about here. So one more thing too, I would say about this, you know, the range of services out there, they're going, obviously the more full service options are going to be a little more expensive, whereas the kind of do-it-yourself options are going to be a little bit less expensive. But yeah, a big range of services out there that we've seen.
We did get a couple of questions in, Amanda, about specific to self-funded coverage reporting. So I think this is the right time before we switch. One question was about, do we have to report for terminated employees who are enrolled in COBRA? There's two pieces to that. If you're an applicable large employer, if it's full-time for some portion of the year, you don't have to do that offer coverage reporting. But that's separate. What we're talking about here is any individuals enrolled in the plan. So even an employee that then elected COBRA, even a year later, and they're enrolled as a COBRA participant, that's going to show up here in this coverage reporting. Or if you look at the list that Amanda walked through here, it's not only employees and their family members, but also non-employees like COBRA participants, retirees, owners. Anyone who is showing up as enrolled in your self-funded plan during the year should show up on this coverage reporting and have the appropriate months marked. The other question that we got that's a really good one is, what happens if we switched? We have a non-calendar year plan. Part of the year, then we were fully insured and the carrier is doing that reporting. And for part of the year, we were self-funded and we have to do the reporting. That's okay. It's just that what's going to happen is there actually will be two sets of 1095s for covered individuals. The carrier will fill out a 1095 with part of the year showing coverage. So for example, if it switched in July, someone who is enrolled all year will get a 1095B from the carrier that has the months January through June marked. And then they'll have a separate 1095 from the employer that will show coverage for July through December, but then they put those two together to get it for the whole year. So if you were only self-funded for a part of the year, then you just marked those specific months when you're doing the coverage reporting.
Great questions. So this is what it looks like on the forms when you go through to actually complete the reporting. So we have a screenshot here specifically from part 3 of the form 1095C. Again, the C forms are what you're going to use if you are an applicable large employer. So this is part 3 of that form for each individual. But if you are small, you're not an applicable large employer, and you're using the B forms to complete the reporting, it looks basically identical to part 3 of the 1095C. So you will need to put the name of the covered individuals in each of these lines, the social security number or tax identification number. If you don't have the social security number for the individual, or their tax ID number, you can then put their date of birth in line C. Then you're going to go through and, like Reagan said, check each of the months where they were covered for at least one day by your self-funded coverage. So yeah, in using Reagan's example, if you were self-funded for only July on, you wouldn't be checking any of the boxes January through June. If someone is covered by your self-funded plan for all 12 months, you can go ahead and check the box in line D here to complete your reporting obligations. Okay. So like I said, ideally we are going to be reporting the social security number or tax ID number on the form. However, this has been kind of an area that we've seen a lot of employers struggle with. You should really already have your social security numbers or tax ID numbers for your employees. But prior to this, there wasn't really any reason for employers to have social security numbers or tax ID numbers for an employee's spouse or dependents. But it is required to complete this reporting. So like I said, you can put the date of birth in there if you don't have it, but you can't just do that and then be done. You are supposed to follow this solicitation process to at least attempt to get their social security numbers or tax ID numbers in order to say that you have fully complied with the reporting process. So the solicitation process looks like this. You're going to make an initial solicitation when the individual first enrolls for coverage, maybe in their application for coverage, there's a request for that. If you don't get it in that application, you would make a second solicitation within 75 days of your initial solicitation. Kind of a tongue twister there. And then if you once again still don't have it, you're going to make a third solicitation by December 31st of the following year. The reason that you want to make sure you're doing this, if you go ahead and you submit that reporting and you don't have social security numbers, because you haven't been able to collect them, or maybe you have an incorrect social security number, this would still be the process you would use for that. You want to show that you were following these steps in case your plan is ever audited by the IRS.
One thing about this here is admittedly the coverage reporting, just getting the name, social security number, and months of coverage is very straightforward compared to what we're going to talk about for applicable large employers. So pretty easy for those of you that are small and just need to do this portion to tackle this on your own. This is the hardest part, is trying to track these down. Even if you have them, this is the number one error that we see that comes back, that when you submit it electronically, the IRS system checks the name and social security number, and a lot of times you'll get mismatches, and then trying to clean those up and potentially correct those where you can is probably the biggest hassle around this particular reporting. I do want to let you know that there's some recognition of that. There is proposed legislation that Congress is considering that would allow us to do this reporting without having to report the social security numbers, at least for spouses and dependents. I don't know if they'll be successful in getting that legislation through, especially if it's combined with other pieces that maybe there isn't the bipartisan support, but they are considering that. That's something to watch for. That being said, at least for this year, we don't have that relief. Looks like we still have to do it, but fingers crossed that maybe that will go through, and in future years, this might not be required.
Mm-hmm. We definitely take a lot of questions during reporting season. We got accepted with errors, and it's typically because of the social security number. So yeah, crossing our fingers. All right, so we included the state individual mandate reporting here still in the self-funded section of this. Reason being, in most cases, if you're fully insured, in-state carriers are going to complete this reporting for you. If you are a fully insured plan, written out of a state that is not one of these 5 states here, but you have an employee that is a resident of one of these 5 states, that employee is still going to need to have this reporting done on their behalf. And for fully insured plans written out of state, it may be the case that the carrier does not complete the reporting in that instance. So we can't just go ahead and say all fully insured plans can ignore it. But for a lot of cases, fully insured plans are going to be off the hook for this. If you are a self-funded plan, it's going to be on you to make sure that this reporting gets completed. Just a little background on this reporting. So when the ACA first came out, and then actually for a few years after that, we were all pretty familiar with the employer mandate part of it, and we'll get into more specifics of that later on here. But it also came with the individual mandate, which assessed a penalty tax to individuals who didn't have minimum essential coverage. The individual mandate itself actually hasn't gone away, but the penalty has been reduced to 0 on a federal level. Once that happened, states came in and decided to implement their own individual mandate, specifically these 5 states: California, Massachusetts, New Jersey, Rhode Island, DC. For all but Massachusetts, you're going to complete this reporting using the same forms, Forms 1094 and Forms 1095. Slightly different situation for Massachusetts. In that case, you're going to be using Form 1099-HC to complete the reporting. We have the deadlines on there also for you, both for the reports to be sent to the individuals and to file with the various state agencies. All those acronyms there are essentially the state's different tax or revenue office that will collect the reporting and assess the penalties on their end. All right, so that was the self-funded part for you. Like Reagan said, if you're not an applicable large employer, the rest of the presentation may not be applicable to you. But if you are hovering near the line, or maybe just you want to see what this is all about, if you were to grow at some point here, it's still going to be useful for you just to get some background on that. So we'll go ahead and jump right in. So an applicable large employer is defined as an employer who averages 50 or more full-time equivalents in the previous calendar year. So like I said, the reporting we're talking about now that is going to be due in 2025 is in regard to the 2024 calendar year. So to determine whether or not you are an applicable large employer during the 2024 calendar year, as you can see in the definition there, we're going to be looking at your employees and their employment status in the previous calendar year. So it's kind of a 3-year process here. You're going to look at 2023 employees and their hours to determine 2024 ALE status, which you will then report for in early 2025. So we have the calculation there for you on the right side of the screen. The way you're going to ensure this is completed: first, you add up all of your full-time employees for each month. Second, you take all of the hours for all of your other employees who are not full-time for each month and add them up and divide that total by 120, again, for each month. Then you're going to add the numbers for each month of full-time and full-time equivalents. And finally, you're going to add up all the totals for each 12 months and divide by 12 to get your full-time equivalent number. So if you are at 50 or more, you would be considered an applicable large employer for calendar year 2024. If you're less than 50, you are not an applicable large employer for 2024. Some tips when you are determining this ALE status. All employees are going to be taken into account here, right? Not just full-time employees. As you can see in step 2, seasonal part-time employees are still going to be counted in some regard. And this is also going to include union employees. You should count all hours of service for any employee that is employed at least one day during the month. And when we say hours of service, we mean any hours that are paid or payable with US sourced income. Another thing to keep in mind, although the penalties that are associated with the employer mandate are assessed on an EIN by EIN basis, a company by company basis, in order to determine whether or not you are an applicable large employer, you are going to look at a controlled group or affiliated service group as a whole. So for just an example, if you had a controlled group with 3 different EINs, right? One with 20, one with 20, one with 10, you've made the 50 mark, and each of those EINs within the controlled group would be considered an applicable large employer, even though none of them on their own actually had 50 or more full-times or full-time equivalents. And then finally, wanted to make the point here on this slide for you that if you are an employer that has gone through or will go through a merger or acquisition type situation, this can kind of be a tricky item. I think it's, if you, first thing, if there is going to be a difference, potentially if the type of transaction was considered a stock or asset purchase, it could make a difference. If the entity who is purchasing another entity, was already considered an applicable large employer, there's just a lot of factors that go into it. And even if you have all of the answers to all of the questions that you need to answer to get to the point where you can say, I think I should be able to figure it out, the regulations are still a little gray on this. So really, I think the point to make there is we definitely suggest reaching out to one of your AssureX partners if you need assistance with that calculation, because it is kind of a complicated area of the law.
Couple of things, Amanda, you actually covered all of these here, but we got questions that we get all the time, so it doesn't hurt just to repeat it. So one question on hours of service and counting those, and what about vacation time? What about sick time? What about if it's bundled in a PTO? If they are being paid, it counts. So those would all of that paid time, even though they may not actually be on site and working, if they're being paid for the time, it does count. So be careful with that. Also got a question going right back to the beginning, and we see this so often for employers that are right on the bubble. What if I've always been under 50? And now, just last month, I went over 50. What do I do? When do I have to comply? We've got it bolded and underlined there. It's always going to change on a calendar year basis. So it doesn't matter that you went above or below 50 in any given month. To decide what your status was for 2024, we're always going to tell you that you have to look back on your average for 2023. If you averaged less than 50, you're off the hook for all of 2024. If you averaged 50 or more, you're on the hook for all of 2024. And then you determine for the following year whether or not. And then when you're doing that counting, make sure that if you have other related companies, and it doesn't matter if they're separate tax IDs, we hear that all the time, but they're separate tax IDs. If there is enough common ownership or kind of shared management and services that they form a controlled group or an affiliated service group under IRS rules, they're combined for counting the 50. So with those three, like I said, you already touched on all of those, but just we get those questions over and over. So I thought it didn't hurt to repeat.
Yep, I agree. And I think just the fact that it's, different rules apply for determining full-time status versus applicable large employer status versus who the penalties, it's a confusing world out there. So I can understand why you would want to hear it more than once anyways. Okay. So kind of wanted to give you a little background on what you're actually reporting here as an applicable large employer. At the end of the day, you are telling the IRS whether or not you should be assessed a penalty under 4980HA and or 4980HB. For any month, if you are assessed a penalty under 4980HA, you're not going to be assessed any 4980HB penalties. So in other words, you can only be assessed an A or multiple B penalties in 1 month, never both. In order to avoid the A penalty, the applicable large employer is going to have to offer minimum essential coverage to at least 95% of their full-time employees. Or if 5 employees is greater than 5% of their employees, all but 5 of their employees would be the metric. And the offer of coverage also has to be to their dependent children. You'll notice here for the subsection A penalty, we're not worried about minimum value or affordability. It is not until we get to the B penalty that comes into play. So that is sometimes where we'll see the MEC plans, right, come in order to kind of save an employer from that A penalty. If an employer does meet the mark for a month, so they offer to at least 95% of their full-time employees, it is still possible for that employer to be assessed a B penalty. The B penalty can arise under a few different circumstances. So first of those being, again, they meet that 95% mark, but there are some employees who are considered full-time that just missed an offer of coverage, right? If that employee then who was full-time didn't get an offer of coverage, goes to the exchange and gets a subsidy for their coverage on the exchange, the employer would be assessed a B penalty for that employee. Or if the coverage that the employer is offering doesn't meet minimum value, or if the coverage that the employer is offering is not considered affordable, any full-time employee who got an offer of coverage but not a qualifying offer of coverage, not one that met those metrics, and that employee went to the exchange and got a subsidy for coverage, the employer would then be subject to a penalty for that employee. It's important to point out here, you can see for both the A penalty and the B penalty, it's going to depend on your full-time employees. You know, prior to ACA days, we saw most employers kind of define full-time employee as 40 hours a week. That may still be the case for your eligibility if you're doing that. At the end of the day, though, when it comes to this reporting and the way that the IRS is going to assess the penalties, you have to use the IRS's ACA definition, right, for full-time status. So what does that mean? It means someone is full-time if they work 30 or more hours a week or 130 hours a month. In order to determine who actually meets those metrics, you have two methods that you could potentially use. The monthly measurement method, which is basically just did they work 130 hours a month, or the look back measurement method, which permits you to measure someone's hours for a period of time before you're penalized, even if they actually do work 130 hours in any of those months during the measurement period. When we say minimum value, again, this is for purposes of the B penalty only. We are saying that the coverage has a 60% or better actuarial value. And then again, for the B penalty only, when we say affordability, what that means is that the employee contribution for single minimum value coverage is less than or equal to 8.39% of the employee's household income. Or, since in most cases you're not going to know the employee's household income, that you meet one of the affordability safe harbors, which we will talk about. And then 8.39%, it's not always 8.39%, that is the indexed percentage specifically applicable to 2024. Okay, so the affordability safe harbors. So we've got federal poverty line, rate of pay, and Form W-2. I like to tell employers, if you meet the federal poverty line safe harbor, go ahead and use it. It's the easiest one. There isn't any reason at that point to even look at an employee's actual income. So for 2024 calendar years, calendar year plan years, that would be $101.93 a month or less. So if you meet that mark, you can use the federal poverty line safe harbor for a 2024 calendar year plan year. If you don't meet the federal poverty line safe harbor, you have the rate of pay and Form W-2 available to you. Few things to point out with these. So for the rate of pay, we get this question a lot. You're going to assume that employees are working 130 hours in a month, regardless of how many hours they actually have. And then you'll use their hourly rate and the applicable affordability percentage for the year. When it comes to the W-2 safe harbor, this may be a more appropriate safe harbor if you are worried about whether or not the coverage would be considered affordable for your tipped employees or your employees that end up with big bonuses at the year if you're not able to take tips or bonuses into consideration, right? Because under the rate of pay safe harbor, that's not what you're going to be looking at. So the Form W-2 safe harbor may be more appropriate for employers that want to be able to take that income also into consideration. You're not going to know what their W-2 wages are until the end of the year, but it could still be used as a device basically for projection purposes for the year. Okay. Wanted to talk about the way that the marketplace premium tax credit works and how someone actually becomes eligible for that. So if you have an individual who enrolls in your employer-sponsored group health plan coverage, they will not be eligible for a premium tax credit. That is the case regardless of whether or not the coverage is considered affordable. So if you are offering coverage to someone that's not considered affordable, but they enroll in it anyways, you got kind of lucky, a little bit off the hook there, right? For employees who are eligible for your coverage, but they waive, they won't be able, again, to qualify if the coverage is considered a minimum value and it is considered affordable for the employee. So they will not qualify for a premium tax credit in that scenario. When we say affordability, this was recently something that was fixed. When we're talking about the single individual and their ability to qualify for a tax credit, we're looking at the contribution amount for single coverage. For an individual's family members, we are looking at the contribution for the family coverage. So how much that actually costs for a family to enroll. So, and like I said, this was not always the case. It used to be that if the coverage was considered affordable just based on that single premium, the family was kind of out of luck, right? Even if it wasn't considered affordable for the family. That has now been fixed. But a big point I want to make here, you don't have to offer affordable coverage to the family members in order to avoid the B penalty, right? It's just the B penalty is only based on affordability for that single only coverage. Okay. So the coverage reporting. Like I said earlier, when you are an applicable large employer, you're going to be using the C forms. 1094C is specifically kind of the cover letter that goes along with the multiple 1095Cs, but a separate 1095 for each full-time employee. So the 1094C gets attached to the 1095Cs and sent to the IRS, and then you send each of the individual 1095Cs to employees. Like what we talked about for self-funded reporting, solutions are going to range from self-serve to full service. Again, you could end up with a service that may assist you with actually filling in the codes, or a service that is kind of more limited to just helping you make sure that you get those forms uploaded the correct way to the IRS. And again, the cost is really going to vary then again, according to which type of service it is. Even if you get a full service type solution, it's going to be important to ensure that you're tracking the necessary data about your employees throughout the year. Because even for those full service options, if you don't have the correct information to give them for them to input into their systems to shoot out the forms are going to be incorrect. So you need to make sure that you are tracking your employees' hours, whether or not they actually enrolled or waived in the medical coverage, whether the coverage provides minimum value, and then what that employee's lowest cost option was that you offered them for single coverage. When using solutions, I think the biggest source of errors that we have seen is kind of, like I said earlier, bad information in, bad information out. And the first part of this is making sure that you are setting up the systems properly with your vendor. So what is your plan here? What is the plan funding? Are you using the monthly or look back measurement method to determine full-time status? What's your waiting period? You need to make sure that you have accurate hours tracking, accurate pay for all of your employees. And then finally, whether or not your plan is minimum value and the required employee contributions.
One thing on the reporting, we got a couple questions on specifically the electronic reporting. One option, especially if you are not a huge employer, it might be possible, for example, if you're in kind of the 50 to 100 full-time employee range, that you're willing to go through and do all of this manually. Although admittedly, there's quite a bit of work that goes into this versus just coverage reporting. And you'll see we've got some examples on the next couple slides. But you could potentially do that. And then there are tools out there that you would simply fill out a spreadsheet. You'd have some instructions and you'd really have to do all of the calculations and data entry yourself. And then what that solution would do would just take care reporting piece. Whether it is for the coverage reporting or for this reporting that we're talking about here, if you're looking for that type of solution and willing to do most of the legwork yourself and just want something that's a lot lower fee, in all honesty, if you just ACA e-filing services, you will come up with a bunch of potential options. So I had a couple of you ask, how do I even find something like that? Also, reach out to the broker partner that invited you here today. They will have explored a lot of these different options for you. And if you go to them with this and kind of service, they should be able to help you find an appropriate solution, and maybe one that they've got some working knowledge of, and can point you that direction. For those of you that are using a more full service solution, certainly more cost involved, but for example, your payroll vendor might offer it, your benefit admin portal might offer it, and all of this data that Amanda was talking about. One of the advantages to that then is you go in and you set it up, but then you can feed it this data throughout the year. You could potentially, get a solution where they ask you for all the data and you do an upload, and then they kind of help, translate that into the appropriate coding. But the other option is a lot of these systems will be tracking all of this hours data and enrollment data throughout the year, as long as you're making sure that that's set up. And then it's a lot easier when you get to the end of the year. It's all there, and they just have to flip that over to the translation. So just kind of wanted to talk through those options, because there are a lot of different ways that you might choose to get this handled. Most important thing, and we can't say this often enough, the carrier is not doing this for you. Your broker is probably not doing this for you. If you are an applicable large employer, you need to make sure that this offer of coverage reporting is happening. The IRS has really gotten strict with their enforcement around this, or aggressive with their enforcement around this, might be a better way to say that. And we are finding too many employers that thought that their carriers were doing this for them, or their TPA was doing this for them. And unfortunately, that won't be the case. They don't even have all the information and data they need to do this reporting for you. So if you are an applicable large employer, please make sure that you have a solution in place, you're tracking the data, and you're making sure that you get these forms in each year.
Great questions. So if you are using the look-back measurement method, we understand that this can kind of be a complicated system to utilize. And again, just in recognizing how important it is to get the correct information into those systems to make sure that you're getting the correct information out. We thought that we would just kind of provide you with this visual of what a standard look back cycle would look like. So typically we're using a 12-month measurement and stability period for your ongoing employee population. We could probably spend an entire hour just talking about the look back measurement method and all of its little intricacies. If you have questions about that, reach out to your broker partners. But if you are a calendar year plan year and you are looking to have your stability period line up with the calendar year, January through December, and you want to use a 12-month look back, this is kind of what that standard cycle would look like for you. So when you're using the look back measurement method, you are using that standard cycle we just talked about to define full-time status for your ongoing employees. But you also need to have a cycle for the employees who are newly hired. So we also have an example here that you could use to look back at to set up that initial cycle correctly in your systems. So we suggest there's kind of two different methods when it comes to the measurement and administrative period. Since that in total, the measurement period plus your administrative period for an initial cycle cannot be longer than 13 plus a partial month, you kind of have two different options. If you want a 2-month administration period to match what that standard cycle typically looks like for the ongoing, you're going to be kind of limited there. You would only be able to offer an 11-month measurement period. However, if you wanted to use 12 months again for your measurement period for your initial cycle, can definitely do that as well. You would just have to ensure that you only have a 1 month administration period in that case. Again, your standard type of cycle for your initial measurement period is going to come with a 12-month stability period also. One thing we wanted to point out here too, even if you are using the look back measurement method, if you have an individual who is hired as full-time, not as variable hours, so you reasonably expect that they will be working 130 or more hours in a month at the time they're hired, you shouldn't be subjecting them to that measurement period before offering coverage. In that case, you would subject them to your normal waiting period if you have one, which should be no longer than 90 calendar days. And again, this is kind of what the standard initial type cycles look like if you need help for setting that up in your system. All right, so specifically getting into the reporting requirements a little here. Like I said before, Form 1094C, the 1094 forms for each of the series A, B, and C is essentially the cover letter that goes along with the multiple 1095s that will be attached to the 1094. In order to completely fill this out in a compliant manner, this is the information you're going to need. It's all essentially going to be employer information. It's going to include how many Form 1085s you are attaching to that 1094, whether or not you are part of an aggregated ALE group. So like we were talking about earlier, a controlled group, right? Or an affiliated service group. If you are part of that, you need to fill that out on 1094. There are certain certification of eligibility boxes that you can also check that may may result in a more simplified reporting option. You need to fill out whether or not you offered MEC to at least 95% or more of your full-time employees. This is probably like the most important thing that I want to stress on this slide, and we'll show you on the next one what that looks like. You're also going to need your full-time employee count and your total employee count for each month. And then if you are a part of an aggregated ELE group, you should also have the names and EINs of those other members of your ALE group in order to input that into Form 1094C. So like I said, this is Form 1094C. We just got done saying you are going to need to know whether or not you offered minimum essential coverage to at least 95% of your full-time employees for each month of 2024. And you are going to complete that part of the reporting in part 3 of your Form 1094C. So if it is the case that you did meet that 95% mark for every month in 2024, you're going to go ahead and check yes in line 23 there, indicating that you did so for all 12 months. If you missed one or more months, you're going to go through and individually select the months that you met the metric for yes, and then the ones you didn't, you're going to select no. If you select no for one or more months, you are essentially indicating to the IRS that if for one of those months you had a full-time employee that went to the exchange and got a subsidy, and it was in the same month where you checked no, that you would potentially be subject then to the subsection A penalty. That is kind of the more expensive, I like to say almost nuclear penalty that we really want to make sure we're avoiding. A lot of times, again, we've talked so much about getting the right information into your reporting systems, but if you don't, and that might result in one of these boxes being checked no when it shouldn't be. So really, if you thought that you should have been making that 95% mark each month and you get the report back and it shows no, go back and look through your data. You don't want to accidentally submit something indicating you may owe a penalty where you shouldn't. Now, obviously, don't lie. If you didn't meet the mark, we're still going to check no, just with the understanding that could come with some penalties. And then finally, the rest of part 3 here is where you include the full-time employee count, total employee count for your reporting there. So Form 1095C is where you are going to report the specific employee information. Part 1 has kind of employer and employee summary. Part 2 is the offer of coverage information. And then part 3, we already looked at. That's specifically for self-funded or level funded plans. So this is part 2 of the Form 1095C, where, like I just said, you report the offer of coverage. So line 14 should always have an offer code for every month. You're either reporting here that you offered coverage or that you did not offer coverage for the specific month. Line 15 is where you input the lowest cost single minimum value coverage offered to that specific employee, right? So whatever the cheapest option was for that employee for single only coverage, as long as it met minimum value standards, should be put in line 15 here. It doesn't matter if they elected family coverage or if they elected a more expensive plan. That is the rate that you're going to be put in here, the lowest cost single coverage rate. Line 16 is where you're going to indicate additional information that essentially is going to potentially tell the IRS whether or not you should owe a penalty for that employee for the month. So for example, if you have indicated in line 14 that you did not offer coverage, maybe you indicate in line 16 the reason you didn't offer coverage is because they weren't employed for that month, or maybe it's because they were not full-time for that month. If you did offer coverage, maybe you're going to indicate that they enrolled in the coverage. If you offered coverage and they didn't take the coverage, you would hopefully be able to indicate that the coverage still was considered affordable by using an affordability safe harbor. Line 17 is only going to be for ICRA offerings, so we can kind of ignore that part of it. And then one note here, if you do leave line 16 blank, that is essentially going to indicate to the IRS that that is a month where you have penalty risk. You know, that the person's not enrolled in it, or it wasn't affordable, right? So if you can't put an affordability safe harbor and they had waived, that is where your risk lies. We just want to include we're not going to go over these in detail, but probably the two most common reporting scenarios, either the employee was not offered coverage for the month, it comes with 1H, and then one of the potential reasons that they weren't offered coverage or blank. And then, or if you did offer coverage, typically you're going to be using codes 1A or 1E. And then again, to see if they enrolled or an affordability safe harbor there if they waived. Getting quickly to enforcement here. So 1094 and 1095 enforcement, letter 5699 is where the IRS says, hey, we think you should have filed just based on the number of W-2s you had. 226J is the letter they're going to send if they're actually assessing a employer shared responsibility type penalty based on your reporting. And then finally, letter 972CG is for late or missed filings. It's important to note here that the good faith penalty relief that we used to have for reporting incorrect information essentially has expired. That happened, I think the first reporting year that was the case was last year. So now we are in our second year or maybe third year of that. So I want to clarify what that means there. You know, I said earlier in the presentation that if you accidentally reported, for example, that you did not meet that 95% mark, you're going to get a letter 226J back in the mail. So you could still say, hey, we did meet that 95% mark. But in doing so, you are then admitting to the IRS at that point that you made a reporting error. That specifically is a reporting error on the 1094C, but even for the 1095Cs, right? So if you make a reporting error on that and you need to correct that, there for the 1095Cs could potentially be a $660 penalty for each form that has an inaccuracy or a mistake. Reason being, we have a $330 penalty for specifically the mistake that you sent to the IRS, and then another $330 penalty for the mistake in the form that you sent to your employees and covered individuals. So just to make the point here that it has become more important to make sure that your reporting is correct. And then finally, we just wanted to give you a little refresher on the actual employer mandate penalties, the A and B. It appears to be that the B is more, this is typically not applied on as large of a scale because it is tied to a specific full-time employee who was not offered coverage, gets coverage on the exchange and a subsidy. But this is just the penalty amounts for your consideration. And with that, we only have a minute left, but I will pass it back to you, Jenny, to do the last poll.
Wonderful. Thank you, Amanda. Thank you, Reagan. Great content. And as Amanda mentioned, before we conclude, I do have one final polling question for our audience. You'll see that pop up here in just a moment. So if you're with us at the top of the hour, we asked you if your company currently offers long-term care insurance. Now we'd like to know your reasons for offering or not offering long-term care. Please select the answer of the question that most closely applies to your company's situation. And as those responses are coming in, I will remind you that we did record today's session. So if you'd like to revisit the content or share it with a colleague, a link to the recording will be available early next week from the benefits advisor who invited you here today. And if you have additional questions about today's content, or maybe we didn't get to your question, please reach out to that benefits advisor and they will be able to assist you. And I will give the poll here just another couple of moments. And we did have a few polls today. So if you're curious about the responses or want to dig in a little bit more, be on the lookout for a piece called a market check survey. So we publish the results of these polls along with some commentary every month in those market check surveys. Again, your benefits advisor can provide you with a copy of that. So if you'd like to review these results in a little bit more detail, that's where you can do so. And if these polls on long-term care insurance maybe piqued your interest, also reach out to your benefits advisor and they would certainly be able to provide you some guidance on the topic. All right, let me close out this poll. I will share those results out with you. We seem to have kind of a wide variety of responses that you can see there on your screen. Again, we appreciate you sharing your insights with these polling questions. We certainly appreciate your joining us today. And with that, we all are concluding today's webinar. Thank you again and have a wonderful afternoon.